All right. Good morning, everyone. My name is Holden Heigl. I'm currently a junior enrolled at the University of Kansas. I'm 21 years old. I'm majoring in business analytics as well as accounting. Also, I'd like to point out I do come from a farming background. My parents are farmers and my grandparents are farmers, so we might have a lot of farming-based examples in this lecture. So today we're going to be talking about basic cost management, and we only have about 10 minutes for this review, so we're going to try to get through everything quickly. We have a vocabulary overview, steps, practice problem, Excel adaptation, and then we'll go to a relevant news article. So first, we're going to start with a little bit of vocabulary. First we'll start with costs, and I think we could probably skip over this one. You all know what costs are. It's just expenses, and one example of that would be like gas. So next we have a cost pool, and yes, a cost pool is not a pool filled with money. But a cost pool is basically the grouping of individual costs, and so a farming related example for that would be like the planting costs. So like you have, like gas we talked about earlier, or let's say you have to pay for seed. We're going to group all that together, and we're going to call that planting costs. So that would be the cost pool. And so next we have cost driver and cost object. So a cost driver is the factors that cause the change. And so the number of acres planted is going to be our cost driver here. So let's say, I guess acres is a unit of measurement. Maybe we didn't know that. But so if we have more acres planted or that we do more fields, our costs are going to go up, and if we do less acres and plant less, then our costs are going to go down. That's why it's the cost driver. And you'd really want to pick a cost driver that's pretty accurately and directly correlates to it. And so acres planted definitely will increase our costs. We also have the cost objects, and these are similar to the cost pool. It's where costs are assigned. And so a lot of these costs, like the planting costs even, we'll call them planting costs and they go towards helping the planting, but a lot of our expenses are going to be basic like maintenance for the equipment. And so even though they go into the planting costs, it's still going to be referred to as maintenance, and that's what will be our cost object. Next, we have to go through some cost classification. The first one is going to be variable costs versus fixed costs. I mean, a variable cost will, is variable with the changes in volume. So if the volume increases, then our variable costs are going to increase. And we'll say the exact same. The fixed costs will be the opposite, where increase in volume will not change. And so continuing with the farming examples, the spraying costs, the cost for fertilizer for the crops, the more crops we plant, the more fertilizer expenses we're going to have. So that makes sense. This left or the one on the right here, you can't see. That's just a picture of some land. And I said land payments would be the example of a fixed cost, because no matter how much you plant, you still have to pay off the land that you're renting. So it'll be a steady cost, not changing if you plant it or not. Next, we have indirect and direct costs. Cannot be traced back to the cost object or pool. So one example of this would be the tires. You can't really figure out exactly how much tread was used at one location as opposed to the other. It's not really possible to directly figure out how they correlate. So this will be an indirect cost, the cost of new tires. While a direct cost is going to be something that's easy to trace, and we'll know exactly where we spent it. So one example of that would be gas. We know exactly where our gas went. We can see it go down. We know where it's at. So then we'll go on to product versus period costs. So a product cost is something that is needed to create the product, and we cannot make the product without it. And so in agriculture, our product would be the crops that we harvest. So one product cost that we have, and we cannot make the product without, would be the seed. I mean, you can't grow crops without seed. While a period cost is something we can create the product, but we can make the product even though we don't have it, but it's still very important. So farmer's insurance is the example of that, and we'll pay that periodically as opposed to with the product costs. So now we'll go through some examples and make sure we really understand the cost identification. So tractor payments, that's going to be a fixed cost because no matter how much we use the tractor, it's just going to have the same payment due at the end of every month. So that's why it would be a fixed cost. The tractor is going to be considered a product cost because we can't make our products without it. It's pretty vital to it, but I could understand why you would consider this to be a period cost. So direct or indirect, this is going to be an indirect cost because we can't directly trace it back. So the cost to pay our accountant is going to be a fixed cost as well. It does not change based on how many acres we harvest. This is going to be considered a period cost. I mean, it's not directly vital to creating the product, and it'll be expensed at the end of the period. That's why it's a period cost. And this is also indirect for the same reasons. Next, we'll go down to the truck driver salary. So this will be a variable cost because the more crops we have, the more crops we harvest, the more the truck driver is going to have to take the seed or the harvested materials in, so he's going to have to work more. So this is going to be a directly variable based on what product we are going out. And this will also be considered a product cost because the product cannot be made without the truck driver. If we don't have the driver to take the harvested soybeans or whatever to the grain elevator to sell, then we cannot sell the product. So we have to have the truck driver. And this is going to be a direct because you can directly correlate how many trips he's going to make based on how many acres we have harvested. So first, we're going to buy $22,000 worth of soybean seeds. And so that will go into our raw materials, just like this. So B is plant 19,000 worth of soybean seeds. So that'll be taking 19,000 out of raw materials and moving it into the work in progress. Then we also have to pay our farmhand, me, $500 for direct labor. Maybe if you don't learn anything else on this, you can learn that the cost of seed is really high and the cost to pay farmhands is a lot lower. Next, we have our spending $1,000 on new tires. We talked about a little bit this earlier, but that's going to be considered our overhead. And so we can go ahead and put that in our work in progress. E, we're going to harvest soybeans worth $20,500. That's the costs that we put into it. And so we're going to take that out of work in progress and move it into finished goods. Farming's a little different. You know, a lot of different job industries, that beginning balance won't be zero. It'll be pretty rare if your work in progress is at zero, but farming, you don't really leave a lot on the field. I mean, if it's ready for harvest, you're going to take it out. You're not going to leave anything there. So then we go over to our finished goods. And we see we had a little bit of soybean left over. So now we're going to take our soybeans to the elevator. And so that's where we're going to sell them. So that means we're going to take them out of finished goods and move them into COGS. And in this example, again, it's kind of farming unique that you're going to, you know, the 100 left behind, you don't want to leave that in for very long. So you're really going to try to take all your finished goods out. And so this example doesn't say it, and it should, that we're going to take $20,600 worth of soybeans to the elevator and sold for $30,000. We'll now go on to an Excel demo. So basically, we're going to go over how another way to tell if, or discuss if it's a fixed or a variable cost. And sometimes it can be, it seem a little bit confusing if an item is fixed or if it's a variable cost. So one way to do it is to make a chart, and I'll go through now how to do that. So we have our information here. This would be our soybeans harvested. That's how many acres we have, and that's what our product is. So now we need to figure out how these numbers correlate, or if they do correlate to it. And so one great feature that Excel has that I think that everyone should use more is you can go to insert, and then if you highlight all the material you want to use in a chart, you can just go to recommended charts, and it'll show you a wide variety of charts that can help us out. I mean, you also can scroll through it and see, you know, what it would look like in different ones. So I would encourage you to kind of play around with that, especially in some of your other classes. You can see what actually would help you the most. And so this will be our chart that we've built here. And you just double click to change the chart name. And you could go ahead and go through the chart and change lots of different things about it. Like you can go up here and change the coloring. If you click on the lines, our soybean line is this orange one. And so, you know, we want that one to stand out because that's what we're comparing. And so basically we come over here and we can look at this, and our soybeans being the orange line, we can see that the yellow line definitely, as the soybeans increase or decrease, the yellow line also is following that path. We can see this blue line here, the tractor payments is going to stay even. It doesn't increase or decrease. So that would make it a fixed cost. So we know the tires, you know, the tires are a variable cost, and we know that this tractor payment is a fixed cost. And then we go on down to the bottom in gas. And I just want to point this out to say that this isn't an exact science, and it can be kind of hard to tell because we go up to our numbers up here and we can see that gas clearly is correlated to how many soybeans we have harvested. It's just a little bit harder to see in this, but you can see, you know, that it does follow the curve. It's just not a perfect method. And I kind of wanted to highlight this is kind of the quick and easy way to tell if it's a fixed cost or a variable cost, and that this is not an exact science. Go on. So another kind of cost management is zero-based cost management. So this is Welch, the company that makes jelly. So basically, to help manage their costs, they start at the beginning and work backwards. And so they basically try to assign what does each cost come from. And they have to go through and say, is this cost absolutely necessary? And I mean, if it is necessary, they're going to keep it in. But if it's not, they're going to have to cut it out. And they basically work backwards as opposed to normal. It adds a lot of discipline. Now, one of the concerns with this, though, is that they'll cut too much out because they'll go through and say, we don't really need this. And then they might miss out on a research and development opportunity or something similar. Wells thought it helped them understand their budgeting, and it helped them understand where their money is going. And so they can kind of figure out how to better spend their money. Walgreens also is doing this, it mentioned in the article, and they had to cut $1 billion in their spending. And this is how they did it, is starting at zero and working their way backwards, assigning what costs it was. So that will conclude the end of this presentation. Please email with any questions you guys have today. Thank you.